Hi everybody, I hope this video finds you well. I thought I'd get in one last video before the end of the year. And I should start it as always, of course, with that disclaimer about this not being aimed at personal advice. It's general information, my general opinion, our house view on things. And of course, anything more individual or personal than that, you should give me a buzz and we can take it up early in the new year. So with that, a quick look back on the year, and I'll make the video as quick as possible. A quick look back on the year shows that a year of real ups and downs. You know, we've had these periods in the investment markets of really strong climbing and strong growth upwards, and then a strong correction. We saw that first of all in March or so with the Liberation Day tariff announcements from the USA. Of course, that caused that immediate drop in the markets, and then as things were reconciled and more commentary made and concessions made on those, that recovery continued to climb back really quite strongly for another 5 or 6 months until, say, October, where another round of corrections happened, and that often happens after strong growth, because at that point the markets were back, the financial markets were back as high as they'd ever been. So a quick recovery, a strong recovery, and like I said, when that happens, you often get some investors, at least, or traders anyway, looking for any excuse to sell. So when the wobbles came along, they did that, and the Australian market corrected about 6% through October into November. Which brought it back down. We've seen a little recovery since then as well. So, but that said, I guess for the year it meant that it was in the indices, the index, there was a fairly flat year, maybe a couple of percent up, and we're really pleased generally with our portfolios that saw returns still mainly in the single digits, but better than the markets, and that's something we strive for after costs. With our preference for active managers, but we'll use index managers where it's appropriate, of course. Anyway, so I think it's useful still to finish off that little comment with a note that even though things have come off a little bit since October, we still draw a line backwards across the markets and see that we're still at an all-time high. If you exclude the last couple of months, the few months leading up to October, we're still higher than we've been since, say, July this year historically. So plenty of reasons to be optimistic. We can find that, and we've said that the last few updates too, of course, and that probably leads us into a quick summary of our last investment committee meeting, which was held a couple of weeks ago, the week before last, and in it it's been an interesting year as we look back too, because we find ourselves at a similar position where we're cautiously optimistic, but I guess that's always the way, isn't it? But we're also, even in the course of a year, a lot wiser. We've seen these great disruptions of trade policy and geopolitical conditions, I guess, but we've also seen then a quick adaptability around the world, and that's changed, I think, the confidence levels. The markets certainly are less reactive than they were earlier in the year, so that's interesting. I guess what we've seen too is that throughout this year, the global markets have maintained that momentum despite these periods of correction. And that's been supported by what I just said, that sort of easing of trade concerns, and the willingness of Federal Reserves, central banks, to maintain interest rates at a level that is conscious of the need for that activity. So that's maintained a fairly steady, if you like, basis for financial markets to operate. A lot of that too has been in the recent corporate reporting season. There's been some high expectations for corporate growth to continue, and of course that backs up share prices. And most of the companies in the most recent reporting season exceeded expectations, so that's been a good confidence booster as well. We've seen that too in the companies that provide AI services. So AI is a very broad thing, and artificial intelligence is seen in a lot of ways, but it's not just the AI companies per se that prosper from that, of course. It flows on to other companies in other sectors who use AI to make their businesses more efficient and more effective. So that's really where we're seeing AI play out in the investment markets. more broadly. So a lot of capital investment into AI-related activity. So we're seeing that as a good support for financial markets as a whole. But it's also really important to balance up this optimism, if you like, or this careful optimism, and recognise that there's a lot of competing factors. And we've talked about this in the last few videos. Despite what I just said, with there being support for markets in a lot of ways, it's also undeniable that where markets are at all-time highs, there's also some overstretched prices in there as well. So, they can sometimes correct with the slightest bit of unexpected negative news. So that's something to be conscious about. And also, there's too a consciousness of uncertainty with the ability of those central banks to maintain interest rates where they are. They've got softening labour data, softening employment numbers, that is, and a clearly moderating rate of growth, which sort of lends weight to them keeping interest rates low. But at the same time too, there's a renewal of inflation concerns as well, which will have them wanting to act very quickly to dampen that and to not let inflation out of the bag again. So government spending too in a lot of places on security and defence and other things will add to that inflationary environment. So these are the things that, once again, reserve banks are going to have to wrestle with. And while ever that's the case, of course, it creates a potential for instability. Notwithstanding all of that, we sort of maintain the view that that there's a favourable environment for risk assets in shares and those kinds of growth assets. You'll recall in recent conversations I have talked about these scenarios that we paint, and overall that hasn't changed from my last video where we look at sort of the chances of a very negative scenario over on this side, being where all of a sudden growth really grinds to a halt, or negative growth and recessions look likely. And we've kept that unchanged at a likelihood of, anything's possible, but we think that's very unlikely, maybe a 10% likelihood in the scheme of things. Whereas when you move up the positivity scale, if you like, to the middle scenario, which is where we think we are, by the way, that muddling growth, as I've referred to it before, where there'll still be growth but at a slower pace, reasons to support economic growth and financial markets, but reasons to be wary as well, as I just discussed. That has us in that sort of middle of the range scenario. And then you get onto that more positive scenario as well, where all of a sudden the clouds clear and a lot of the geopolitical concerns evaporate and growth is at a much higher rate than expected. We think that, as well as at a fairly low percentage, maybe 20-odd% or 30%, say. So where we're looking at is sort of 60% likelihood in that middle scenario, 30% likelihood at the high end of the range, and maybe a 10% likelihood of a really quite negative, unexpected outcome. So again, I hope that makes sense, but it just means that overall we have a net positive view of things. But of course, it's as usual spiked with potential for problems. So we maintain our moderate, balanced kind of approach to things, heavily factored by what's important to the individual. What risks, even measured moderate risks, can and should be taken, depend on the circumstances. So, we've been saying that for 20 years, so it really won't change, but it's just a matter of reinforcing that despite all the noise and everything going on, we stick to our disciplines. That's probably the main thing to say. It was, I guess, maybe a reassurance as we hit the holiday season, and that things will hopefully carry on as normal. There'll be no shocks or upsetting news, and over the Christmas break we can switch off and enjoy it with our families as we should be able to do after another year of hard work. So for us here, for me and Tyler and Tracy, and the others about the office. We've had a really good year, thank you. We've loved all of our conversations with everybody. We've welcomed a few new clients, a few new families to work with us, and very excited about that. And we, like I said, find ourselves very lucky, very fortunate to be dealing with such good people. So we hope that you have a wonderful Christmas, a wonderful break, happy and safe and relaxed and restful, and looking forward to our chats in 2026. Take care.